Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, July 28th, 2020. Um, you'll notice I'm not in my usual spot. Quite frankly, I have that nice background, but it's so big, it lives in my garage, and it's too hot in my garage today. So here I am inside the makeshift office that I'm using these days. In what used to be the kids' playroom, but I guess that's fairly typical of many people. What we're seeing today is a little bit of a reaction to yesterday. It wasn't really clear why we rallied yesterday, other than that we were coming off of 2 days of losses in the broader markets, and so buy the dip still remains a strategy that works for most people most of the time, and it worked for people yesterday. And today, what we're seeing is a little bit of a pullback. I guess the most notable one is a rally overnight and then a bit of a sell-off in gold and silver. Seems like a bit of a buying climax. Whether that's short-term or medium-term or longer-term remains to be seen. The basic thought about gold is I look at it more as the anti-dollar or the anti-fiat currency, for lack of a better word, which is actually why you saw Bitcoin rally yesterday. I think there's people moving out of the dollar, and there's been this thesis, which is, I think, a very solid one, that events are not moving in the dollar's favor. We have we're going to be building up huge deficits that need to be financed. As of now, the market does not seem to be having a problem doing so. The government seems to be able to sell their debt at very low rates. But the thought would be that over time, you're going to start to see a bit of a rising yield curve as the government has more and more difficulty selling the debt it needs, and that we're going to start to see a reaction in the dollar accordingly. As it is now, we've started to see the euro strengthen considerably against the dollar. Why? Well, one of the reasons why people liked the dollar so much was it was the one place to get some yield on a risk-free basis. When the rest of the world is negative, well, you can come to the U.S. and we were paying out low but positive rates. Now our rates are effectively zero. There's currency risk involved, and so it's not the layup it was. When you go back to it, we're actually effectively paying out negative real interest rates now. Because there is some inflation, as long as inflation is a non-negative number. And to be fair, it's not clear that there's going to be a lot of inflation on the horizon because we remain in this stagnant to lower economy until we can get COVID behind us. But still, actually, quite frankly, if you have a dollar that's weakening, that imports inflation if you import a lot of your goods because you're paying for them with a deflated currency. There's a lot of circular reasoning here. It's tough to unpack it all. But the bottom line is the thought, and one of the investment theses behind gold, and I guess I'm dressed appropriately today. One of the investment theses is, well, gold doesn't cost you anything to own in a negative real interest rate environment, right? If one of the knocks on gold, silver, et cetera, hard assets of any sort is they cost you money in terms of opportunity costs because you're foregoing any interest you would receive otherwise, and they basically a lot of times they'll cost you money to store. If you have enough gold, you got to put it someplace. Presumably, you're not just leaving it on your coffee table if you buy physical gold, or if you buy gold in sort of an asset market, you're paying someone to store it. So there's an expense to holding assets of any sort. I remember a neighbor of mine who was a cotton trader who told me one day, well, at the kids' Little League practice, that his basement was full of cotton. He happened to have a basement where he could store cotton and did so occasionally. He took delivery, but that's the extreme. You generally need to put stuff someplace, and so that has a cost. And so the negative, if it's going to cost you to hold money on a negative real interest rate basis, what's the difference at that point? You might as well take your shot in terms of gold. I think a lot of people see gold and silver as a free option. It's not clear to me that that's the case. But there's sort of a free look at a declining currency. Nothing is free. Let's be real. And And the one thesis that I would have, for gold is I would think if I was an emerging market, if I lived in a country that could not run its own printing presses to borrow money, meaning it had to borrow money in a foreign currency, um, then I would think gold is a slam dunk for every portfolio, because you always run the risk that your country might need to devalue to pay its debts, or run into some sort of currency crisis, and gold is the ideal hedge in that situation. If you live in a developed economy where they really don't have much trouble financing their debts and printing their own money, gold is a little less of an investment thesis. Besides gold and silver, which have dominated so much of the investment talk, we ran through this yesterday. I urge you to read my piece from yesterday. There's a lot coming down the pipe this week. Yesterday was a kind of a nothing day because we were waiting for the Republicans to put out their stimulus proposal. Today we received it. The market kind of greeted it with a yawn, because I think most people realize that the two sides are far apart. And it's not even clear that the Republicans agree amongst themselves. So that was underwhelming. So I think that's why, at least at the time I'm taping this now, we're seeing a slight sell-off in the U.S. markets. But the big stuff starts to come tomorrow. You get the Powell and the Fed releases its meeting. It basically has a meeting release at 2:00, and then Powell has a press conference. Those have not been regarded all that well. The last couple of press conferences we've seen declines either that afternoon or the following day. We're also seeing the big four, what I would call them, the four horsemen of tech, testifying in Congress tomorrow, and then all releasing their earnings on Thursday afternoon. So there's a lot going on here. And I think we just scratched the surface of it. It's probably an opportune time to reassess your risks, particularly if you're invested very heavily in NASDAQ or the four stocks, which comprise about a third of NASDAQ, that are reporting within about a few minutes of themselves after the close on Thursday. So going into Friday, there's a significant amount of risk that you might want to be re-examining before that. We'll talk again about this soon. Take care. Bye-bye.